How accessing money from an IUL actually works. In this educational episode, I'm going to explain that there's a sad way, a dumb way, and a smart way to access money out of an IUL policy. Of course, my favorite is the smart way, and there's two different ways to do it the smart way. So get ready. You're going to be blown away with what I'm going to share with you. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping thousands of people optimize assets, minimize taxes, and prepare for a comfortable retirement so they will not outlive their money. Well, one of my favorite financial vehicles that eliminates the dangers of taxes, inflation, and market volatility, those 3 dangers, by the way, are what cause most retirees to outlive their money. My favorite vehicle that eliminates those dangers is a max-funded IUL policy. And so it allows you to accumulate money tax-free, and you're able to participate when the market goes up and not lose money when the market goes down by using this strategy called indexing. And if you don't understand how that works, be sure and search other educational episodes on this very channel. But in this episode, I want to talk about how do you access money? Because usually people that I would help would accumulate money tax-free, but then they wanted to use IUL for living benefits, not just a death benefit. In fact, that was the whole idea behind Universal Life when E.F. Hutton came up with the idea in 1980. They wanted to use the tax-free accumulation and tax-free access for living benefits as a superior alternative to IRAs and 401ks or investing in the market where it's volatile and so forth by using insurance for living benefits. So in a nutshell, if you don't understand what I'm talking about, you're taking the least amount of insurance that the IRS will let you get away with, and you're putting in the most premium or the most money that the IRS allows as fast as they allow. And so if you wanted to reposition, let's say, $500,000, which I've had many clients do, even clear back in 1980, you could have bought a ton of life insurance coverage for $500,000. That's not the objective. You wanted the least amount of insurance, and so it was usually about double that. For $500,000, you were required to have $1 million or $1,250,000 if you were a 60-year-old, let's say. The younger you were, you had to have more insurance. But see, the objective was to earn a rate of return like many of my clients did from 1980 to 1990. They got credited between 11 and 3/4 to as high as 15.5%. Let's just round down to 11. They wanted to earn 11% gross and net over 10. Yeah, our clients did. They were able to earn 11 and net 10 because the cost of insurance only depleted or drained out 1 percentage point out of the 11% they were earning. And so they were netting cash on cash 10%. And so if they put in $500,000, they were netting 10%. That's $50,000 a year, and many of them started to take out $50,000 a year of tax-free income. Yeah, it knocks the socks off of other alternatives. You would have to be earning 15% in a tax-deferred IRA or 401k in the market to net 10% in a 33% bracket after paying tax. You only had to earn 11 to net 10 in an IUL. And so there was a massive exodus of money that left the banks and the brokerage firms and what have you into these because these were safer. They paid higher interest, and they were not subject to the market downturns. Your money was out of the market, and you were able to earn 11 to net 10 instead of having to earn 15 to net 10, having your money in the market in a tax-deferred account. Because money inside of an insurance contract, it's tax-free under Section 72E and 7702 of the Internal Revenue Code. 72E, you accumulate your money tax-free. 7702 tells you how you can access your money tax-free. Now, one additional section of the code, 101A, says at the end of the day, anything left in the account, the policy, blossoms and transfers income tax-free. But the main objective for most of my clients has been the living benefits. So you can access money by dying. That's the sad way. If I put in, $500,000 or even just $100,000 and I die in an unfortunate accident and I have $1 million death benefit, that's one heck of a return. I put in $100,000 and I die and my kids, my spouse gets $1 million tax free. That's one heck of a return, but I don't recommend that one, but it protects me. There's the dumb way. Now, let me just simply say this. If I had, let's say, $500,000, let's go back to that $500,000 example back in 1980. If it's earning 11 and netting 10, that's 50,000. Now, if I withdrew 50,000 a year, it's tax-free for the first 10 years in that example because life insurance is one of the very few investments taxed FIFO instead of LIFO. If you don't understand FIFO versus LIFO, LIFO means last in, first out. Annuities are taxed LIFO. If you put $500,000 into an annuity and you start pulling out $50,000 a year, you have to pay tax on that because the last money you're earning, your interest, is the first money coming out. It's taxed LIFO. Life insurance is taxed FIFO. And so the first money you put in, that $500,000, if you're pulling out 10% a year, it would take 10 years before you recovered your basis or that $500,000. That's tax-free because it's already been taxed. But that's dumb because starting in the 11th year in this example, you would be paying tax on that $50,000 from that point forward. You don't have to do that. The IRS actually says, well, that's stupid. You can do it the smart way. What is the smart way? You simply say, I want to borrow the equivalent of my interest. So sometimes critics go, what? Borrow your own money? Why would you do that? Here's why. Because loan proceeds are not deemed earned passive or portfolio income. They're totally tax-free. You don't have to pay tax when you borrow money to buy a car or house. You don't have to pay tax on that. That's not income. So why would you do this? Well, because if I have $500,000 in there and I'm earning 10%, the insurance company will loan me the equivalent of the interest they're earning. So if it's earning $50,000, they'll say, we'll loan you $50,000 because the interest you're earning on your $500 is 50. So the interest this year of $50,000 is collateral for the $50,000 of interest we'll loan you. And so, yeah, it doesn't cost you anything because the insurance company will maybe charge you, because it has to be deemed a true loan to be tax-free. They might charge you 2% on that $50,000 loan, but they're crediting you the same 2% on the $50,000 of interest that you left there to collateralize the loan. Now, the other $500,000 is still earning 10, but see, that's called a zero-wash loan. The loan balance sits there and maybe accrues at 2%, but the cash value that's collateralizing that, the interest is also compounding at 2%. It doesn't cost you anything. So that's called a zero-wash loan. But the smartest way is an index loan. And so an index loan is where, and sometimes they're called participating loans, and that's where the insurance company usually charges you a little bit higher interest, maybe as much as 5%. So this is where in a year that you feel bullish about America and you're accessing money, you can borrow and they'll charge you 5%. And then they will credit you on all of your cash value plus the interest you're earning. They'll credit you the indexed rate. So on this example, if you had $500,000 and let's say it's earning 10%, that's 50. Now you're earning the indexing rate on the entire $550,000. And then as that continues to compound, you keep earning the full interest rate on the compounding amount. Well, why would you do that? Because historically, if you just did that and never changed, you would likely earn 2% higher than the cost of 5. You'd probably earn at least 7 versus 5. And this extra 2%, it's called a 2-point spread, will actually have you coming out ahead to where on $1 million nest egg, you could pull out 10% a year without depleting principal, even if your insurance contract was only earning 8%. You're earning 8, but you're pulling out 10% and not depleting it because you're earning an extra 2% spread. You can do that, and it's a no-brainer. But because we teach a lot of IUL agents how to rebalance and how to diversify, this is where most of our clients are able to earn 11 and net 10. So if you borrow at 5 and earn 10, how much more is 10 than 5? Don't say 5. It's 100% more. So I'll give you an example. In 2017, I had a savvy business owner who keeps his working capital in indexed universal life insurance policies. He needed $1 million to tie up a piece of property, an apartment complex, for an earnest money. He just said, Doug, email me that one-page form, and he puts his name and his policy number on there. And it simply says, do you want to withdraw or borrow $1 million out of your IUL policy? And he goes, I want to borrow. Well, do you want to use a zero wash or zero cost loan, or do you want to use indexed? And he felt like, 2017 looks pretty good. And he chose the index. That year, he got charged 5% on that $1 million loan. That's $50,000. He didn't have to write out a check for that. It's automatically deducted from what he earned on that $1 million that stayed in the policy as collateral. Guess what he got credited that year? 25%, $250,000. So he earned $250,000 on the full $1 million, okay? And subtract the $50,000, he netted 20% or $200,000 of tax-free growth on his $1 million, while he was technically using it in his business to make $3 million to buy, fix up, and flip an apartment complex. If this is like blowing you away, it ought to, because this is the smart way to access money. So that's how it actually works. If this is intriguing you and you want to learn more, you ought to study examples of the smart way to access money by reading my book, The Laser Fund. Now, this has been flying off of our warehouse shelves. We send out hundreds of these every single week. It retails for $20 on Amazon. You don't have to pay that unless you would like to, because I'll gift you a copy free. To claim your free copy, you simply go to LaserFund, laserfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I cover the rest of that cost. I'll pay for the book. I'll fire out a hard copy to you. There's also options in there if you would like to listen and learn and watch and learn too. Check out the educational webinars we teach on a regular basis. You can even schedule an appointment with an IUL specialist that I oversee and mentor to see how one should be designed correctly for you. But enjoy this. This is actually 2 books in one. This side is for left brain learners with all the charts and graphs. This side is for the right brain learner. It has 62 actual client stories. So you can learn left brain, right brain, or you can use your whole brain, okay? But this is about you, your brighter future. You're going to miss out if you do not educate yourself, and you'll quickly learn how to access money the smart way and become what I call your own banker.